All right, so it is Friday, March 21st, and this is going to be your first of two lecture videos that you're going to be watching today. So hopefully you have another good day, and I look forward to seeing you again on Monday. Lesson plan's all set for you, so hopefully you have had a chance to read that over, and you're beginning with this lecture video, which will take no more than a half hour total. Two videos, so it's easier to upload. Okay, so where we pick up today, yesterday we talked about the election of 28. And we really had our last day of enjoying the fun and prosperity and frivolity of the 20s. Today we're crashing the market, and we're going to answer the question, how did a market crash that impacted a relative few immediately ultimately lead to a Great Depression that led to devastation for the great majority of Americans? So let's begin. The politics of the politics of the Great Depression notes packet that you got yesterday will be helpful. If you weren't here yesterday, grab one from the substitute. And we're going to begin on Roman numeral 3. So, the anatomy of a market crash. We talked a little bit the other day about what stock is. And one of the big things you've taken from hopefully my little mini lesson on that, from the videos, from the readings, is that stock was, to most Americans, a relatively new phenomenon in the 1920s. Now, at its peak, only about 10% of the population had money in the market, so the vast majority did not. But for those who had money in the market, it was a much greater number than ever in the history of America ever before. And the great majority of those who were in the market were first-time investors, meaning they didn't know the natural ups and downs of a market, that they always thought it would be what we call a bull market, strong. Sometimes the markets turn bear, weak. Now we know that today. The natural business cycle, ups and downs of an economy. People in the 20s didn't get that. Who invested in the market in the 20s? The biggest investors in the market were businesses. So businesses that often had their own stock, they buy stock in other companies. And they could buy a whole lot more shares than individuals. Banks. By the 1920s, it became understood that banks were not, anything you should be scared of. Banks were places where you should put your money. In the longest time in American history, if people had cash on hand, they'd store it in a box in a closet. They'd hide it somewhere in their home. It's not the safest place to be. So by the 20s, with so much money floating around, and not just cash money, but in the 20s, so much of the money was money on paper, not paper money. As you bought things on credit, installment buying, you put a little bit down, you paid the rest later. So by the 1920s, so much of money was what you would go to the bank and you'd get a statement and you'd say, okay, I have X number of dollars in this bank. I've got $2,000 in this bank, which would have been a heck of a good amount of money back in the 1920s. Well, what happens? The stock market is so much about psychology. The market went up and up and up every year, often people making 10%, sometimes 20%, incredible amounts in dividends. As 1928 turned to 1929, however, things started to change. By the first quarter, the first 3 months of 1929 ending, the market started to stagnate, meaning that it wasn't growing at a level that it typically had grown at. Nowadays, we wouldn't think a lot of that. But back then, again, the market always grew. So many people, Wall Street investors, banks, businesses, regular people who have a little money in the market, all start to worry and wonder, why is the market not growing as it normally does? It rebounds some after that and increases. But as summer turns to fall, for the first time in ever for many investors, you begin to see a sharp decline. The value of stock going down. Now, what is stock? Stock's a reflection of the company that the stock is of. So if the value of a company is going down, so too will that stock. Here's the deal. By the late 20s, many stocks had gotten artificially priced too high. meaning that there were so many stocks out there, so many lucrative businesses and companies, that many of them artificially had gotten too big in terms of what they really were worth. You also had, with this big consumer era, an overproduction of consumer goods. What if people slowed their buying down? You'd have warehouses full of goods, shelves of goods, lots of cars that people aren't purchasing. You're also seeing a global decline. Understand, we'll talk about this much more next week, the Roaring Twenties was an island into America. It was not something the rest of the world was experiencing. Most of Europe has had a miserable, depressed 1920s, still rebuilding from the horror that was World War I. They're not making purchases at levels that would help us. There's all kinds of reasons why the market's going to crash, and I can't give you one. The best answer is we were due for a bad time, due for a bear market at a time Americans didn't know that would happen. September's ugly. October's uglier. By mid-October, many stocks have lost in value, upwards of 10, 15, maybe 20%. A lot of investors are selling. Sell, 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 sell before we're going to get hurt worse. And then it happens. October 24th, 1929, also known as Black Thursday. Many stocks fall in value on this day by 20 to 30%. Some fall as much as 50% in one day of trading. It's a bloodbath on the floor of the stock exchange. Friday's not too good either. Markets are closed on the weekend. Monday's rough. And then, one of the darkest days in American history, in a day that doesn't involve war or attack. Tuesday, October 29th, 1929. Forever to be known as Black Tuesday. Men who traded will tell you on that day they felt eerie when they walked in. And when the opening bell rings, sell, sell, everybody's selling off stocks as quickly as possible. As the stocks are being sold, the value of the company, the value of the stock is rapidly declining. By noon, by lunchtime, just in a few hours of trading, there are a number of stocks that had lost over 50% of their value in 1/2 of a day. As the afternoon goes on, it gets worse. When the final bell rings later that afternoon, there are many stocks that lost 100% of their value in one day. Stocks that just weeks earlier had been quite lucrative are now penny stocks, meaning completely worthless. Well, in the short term, remember, everybody's got radios in 29. Americans hear about this, and it's scary. But in the short term, most Americans are not immediately affected by the market crash at 29. Because most Americans, 90-some%, don't have any money in the market. None at all. A lot of Americans say, gee, that's unfortunate, but it doesn't really affect me. There's a few people who kind of think it's funny. Ha, ha, ha. You know, I see those wealthy Wall Street investors being driven in their limos every day. I wonder what's going to happen to them. But please understand, a market crash that affected a relative few will turn into, be the catalyst for a depression that's going to impact many. Why? Well, let's think about what's going to happen as the days, the weeks, and the months progress further. Imagine it's now March of 1933. Over 3 months since the market crashed. 4 months, over 4 months. Imagine in early March 1933, you're a worker on a factory floor. You make good money. Your foreman comes up to you, though, and says, need to see you guys in the office at the end of the day. That's never good. You wonder, in that last hour of work, did I do something wrong? I was here on time. I haven't messed up today. You go up the long walk to the foreman's office, and the foreman says to you and a couple others he called in, guys, it's nothing to do with you. I like you. You're good workers. But you're done. Today was your last day on the job. Here's your checks. You're fired. Fired? What did I do wrong? Nothing. You didn't do anything wrong, he says. My boss told me I've got to cut my workforce by 20%. We're hurting. This company got clobbered last October in the market crash. Lost so much money. We got to cut costs. You're our greatest cost. Sorry, guys, I got to let you go. Well, you go home, you tell your family you're hurt, you're angry. But you say, you know what? There's a lot of other jobs out there. To heck with them. I don't need to work there anymore. A couple days later, you start looking in the want ads in the back of the newspaper. They advertise jobs there. And you find one. You find a couple. So you say, okay, it says they're going to have opportunities to meet and talk about this job on Tuesday at 7 a.m. So you wake up early that day. By 6 a.m., you're on a streetcar. By 6:20, you're at the place you're supposed to go, the address. You got your hat, your jacket, your tie, you're well dressed, and there you are. You walk out of that streetcar, you walk a few blocks, and you see a line of about 100 people. You ask the guys in front of you, what's going on here? And they're kind of confused. You walk up to the line, say, what's going on here? Oh, this is the line for that job that's open. We all saw it in the want ads. There's 100 people in line in front of me. Now there's going to be 100 people behind me for one job? Yes, because so many people lost their jobs recently like you. The market crash didn't affect you at all, but it is now because your bosses, the people who run the company you work for, were clobbered by it. And now you just learned the hard way, one way that the market crash could impact you. You'll keep looking for jobs for the next few months, but every day you show up looking for one, it's the same thing. Eventually you see 50 people in line, you just walk away. I'm not going to get the job. So many men become depressed, psychologically depressed, demoralized by this. You start to worry. I only have so much savings. I don't have any income. What am I going to do to feed my family? What are we going to do to pay our rent, to pay our mortgage and keep our house, pay off those credit bills? Oh my gosh. Some of you might have even laughed at those Wall Street investors who got clobbered in October, thought, they're going to lose their fancy mansions out on Long Island next to Jay Gatsby. Literary reference. If you don't know what that is, read The Great Gatsby sometime. Classic novel about this era. They're going to lose their limos. They're going to lose their servants. You might have even chuckled about it. You're not chuckling anymore. No way. This market crash could impact so many. Let's move on to video 2 so we have enough room. So let's transition right to lecture video number 2 for this lesson.